John Bilton is Global Head of Multi-Asset Strategy at JP Morgan Asset Management. They're having a big JPM thing in Singapore today, and he found time out of his schedule to join us. John, thanks for making time to be with us. So when we see sell-offs like 2.5%, 3% in China, those of us in media go, oh my God, is this the beginning of the end? I mean, you always have to ask that question. The answer is probably, as you and I were talking about during the commercial break, a lot of people are out of the market. The volumes have come down, so you get a magnification or exacerbation effect, right?
Yeah, I mean, look, it was Thanksgiving Day yesterday. It marks the beginnings of the run into the holiday period. You're lacking as well the sort of directionality that Wall Street often sets for all of us around the globe, whether here in Asia or us back in Europe. And, as a result, you can see outsized moves. That said, you have a situation where bond yields pick up after so many, many years where they've been compressed. I think it does cause people to ask questions. And I think it's indicative of the environment we're in today, which is perhaps more healthy. People are looking at and digesting what's going on in other markets, asking the question, rethinking about how it discounts through to from bond markets into stock markets. And, that's a sign of, to my mind, a good functioning market. There will be volatility, there will be pockets of modest correction, but broadly speaking, the underlying global growth environment's pretty good, and it's that we think is going to drive equity markets over the next 12 months.
Yeah, just one more on China, John. Does it bother you that this kind of market can be swayed by the media, by the official mouthpieces? If the government decides that enough capital gains are enough, then they can call a stop to it like they did in 2015. It just kind of tells us this is not a market-driven market entirely, right?
Yeah, well, think about where China have come from. I mean, it was only a couple of years ago. It was a very sort of solidly, singly set exchange rate. It's gradually opening up, gradually liberalising. These things don't happen overnight. So we think that China is a big and deep market which will continue to liberalise over the longer term. And, that means that there is perhaps a bit more attention on policymakers within China than they may be in other markets, but that does not mean that it's not a legitimate investment venue over the longer term, in our view. I think your headline sort of homes in on the point. It's not just about the US and emerging markets. Don't forget, we've got big blocks of markets which are doing pretty well, both in terms of growth and also in terms of equity performance, and that's Europe and Japan. And when we think about the way in which we look at markets, which is, they're governed predominantly by global growth, which is looking good. What are the two regions that are growing most strongly above trend? Well, that's Japan and that's the Eurozone. And as a result, that should feed through, we believe, into earnings. And over the sort of 12 to 18-month horizon, it's earnings that drive equity markets. And so as a result, when we look at our allocation today, yes, we've got a core allocation to the US. Yes, we see upside momentum in emerging markets. But don't take your eye off the fact that there is a significant structural improvement going on, not only in the Eurozone, but also in Japan. And we're seeing that come through in Japan with better payout ratios, better sort of channeling of corporate profits back in to end shareholders. And within the Eurozone, we're seeing a gradual improvement of the banking infrastructure and improvement of growth, so much so that when we run our long-term numbers on the Eurozone, we've actually been able to upgrade the long-term trend growth in the region for the first time in a decade. And that, to us, is significant for the outlook for equities there.
Right. John, let's talk about Japan for a second here. Whenever I talk to people about Japan, I get the sense that it's because of a relative value case here. I mean, it has not run up. At 22,000, it is still 16,000 beneath its all-time high. So it does not have the features of other markets. And that's it. That's the story.
Well, not so much. I mean, look, you wouldn't expect to enter a bubble territory once again like we were at the back end of the 80s, but you're looking for something which is sustainable. And one of the issues that Japan had faced is it had reserved way too much of its corporate earnings back into its equity base, which had pushed down returns. There wasn't much of a culture in terms of distributing cash back to shareholders. And as a result, the corporate sector, produced relatively low returns compared to the rest of the globe. What we're seeing in Japan today is a much, much better outlook in terms of growth domestically, but B, we're seeing much greater corporate discipline. Buybacks are back on the agenda, dividends are picking up. Margins are way more defendable than they've been, we feel, in a generation. And as for valuations, well, you know, it's difficult to gauge on a market which has been in a 20-year decline up until 2012, 2013, what's the appropriate relative valuation. But when we build it from the fundamental building blocks of earnings and margins, actually the outlook is pretty attractive.